Some of y'all have stocks, crypto, Webull, Fidelity, Charles Schwab, and at least 3 finance apps on your phone, but you're still broke. So today, we're going to talk about why investing alone is not enough to build wealth. My name is Flo. I'm with Heavy Returns. We've built a community that focuses on educating the public on finance, dumbing things down for the everyday man. That is our sole purpose, to take you from untrained money to trained money. Now, the whole purpose of this particular episode is to dive in why think that you're doing all of the right things when it comes to investing, but you just need to tweak it a little bit. Now, I just need a couple minutes of your time so that we can fine tune your approach and make sure that you can start seeing some of these heavy returns. See, the first reason why you're investing, but you're still broke, is because you're buying things without doing any single research. Now, I get it. You log into Instagram and you're seeing post after post about all of these gains, how Trump has said this and the stocks went up, or how somebody invested $20 into this unknown stock. Now they've made $1 million. See, those things are far and few in between. See, if you're a trained money investor, you'll actually take the time out to understand what's going on in the market before you waste your hard-earned money. For instance, just because somebody tells you about a stock doesn't mean that you actually have to buy that stock. Probably need to do your due diligence before you invest your money. See, the first reason why you're investing but you're still broke is because you're buying these stocks without doing any research. You ain't jumped on Yahoo Finance. You don't understand the price to value ratios. You haven't looked at free cash flow. You don't even understand if this stock has actually beat earnings in the last couple of years. See, that's the problem. You'll hear about a stock from somebody else, but you won't take out the time to do your homework. That's untrained money. See, now trained money is going to look at valuation metrics to see whether or not a stock is undervalued, fairly valued, or overvalued. So you need to understand that price and value are absolutely two different things. The best investor of all time is Warren Buffett. And he says something that's so crucial, and it actually sticks with me today. He says that price is what you pay, but value is what you get. So if you're listening to these people and they're telling you about these meme stocks, these stocks that are up one day and down the next, before you dive into it, you need to understand whether or not it's undervalued, overvalued, or just fairly priced. That is the question that you need to ask yourself every single time before you invest into a stock. Now, some of y'all may actually have a Netflix subscription. I believe that Netflix is about $20 a month right now. Let's say I come to y'all and I say, I'm going to sell you a Netflix subscription for $10. Clearly, that's obviously a steal. In that particular instance, that's where the Netflix subscription will be undervalued. Why? Because if price is normally $20 and you're getting it for $10, why wouldn't you hop on an opportunity? Same example. Let's say that I knock on your door and I say, hey, man, I got these Netflix subscriptions. I'm charging $100 a month for each one. Wouldn't y'all slam the door in my face? I know I would. Why is that? Because it's overpriced. Price is what you pay and value is what you get. So before you invest into these meme stocks, you absolutely need to understand where it is at in terms of its value. Another thing that you probably need to research is you need to understand what it actually does. Some of y'all are investing into ticker symbols and y'all don't know what kind of company it is. Before you purchase a stock, you need to know exactly what the company does. Is it a tech company? Is it in healthcare? Is it in energy? See, these are the things that you need to know because there are events and other macro factors that may actually impact that particular company. For instance, oil stocks were actually down because the Strait of Hormuz was limited with its supply. Less supply, that means more of a demand, which means higher prices. But once they opened up, guess what happened to oil? It shot down. But if you're buying these particular companies, for instance, like Exxon or Chevron, and you don't know that they're actually oil-based companies, you wouldn't know for the things to look for. So it's very important that y'all actually look at these particular companies, know exactly what it is that they do, and understand the sector that they're involved in. So that way, if anything happens, you're over-prepared. Another thing, y'all need to have a buy and sell plan. Understand the time horizon for everything that it is that you purchase. For instance, if you're buying Ford, a company that traditionally makes gas vehicles, do you think that over the next 20 years that they're going to continue to be profitable if they don't start diving off more into electric vehicles? Who knows? But a lot of people consider these particular companies dinosaurs. So you have to have an exit plan. And the best way to know what these particular companies are doing is by staying up to date with maybe news sources that can educate you on one of these companies. So before you buy, understand why you're buying. You're buying probably because this particular company is undervalued. Now, the moment it gets overvalued, it's okay to stay in as long as your thesis doesn't change. Because if the market is still pouring in money, you might as well keep collecting. But if your thesis changed because something major has happened to that stock, that is your exit plan. That's trained money. You got to know when to get in and then also when to get out. You can't just rely on screenshots. You can't rely on Twitter or anything like that. That is not an execution plan. That's just gambling with Wi-Fi. So y'all need to lock in. Before you buy a stock, you need to understand why you're purchasing it, when you're purchasing it, and when you plan on getting out. Y'all might hate me for this, but y'all got to stop interrupting the returns. See, there's actually three major reasons why you're not seeing the returns like everybody else. Number one, you don't have DRIP activated. Now, DRIP is dividend reinvesting. What that means is if you own a particular stock and they issue a dividend, all you have to do is contact your broker and have them roll those dividends back into the stock. And what you'll notice is that over time, this will begin to compound. That's called the drip. They're releasing a dividend and you're actually cashing out. They'll issue it to your brokerage account, but it's just sitting there. It's not being put to work. That's no different than money sitting at the bank. That defeats the whole entire purpose. So if you have a stock and it issues dividends, it might make sense to go ahead and roll those dividends back into purchasing more of those shares. And what you'll notice is that over time, it gets bigger and bigger. See, that's how you make your pot grow. Another way that people actually interrupt their interest is that they withdraw too early. They see the market go up, oh, I'm going to take it. They see the market go down, oh, I'm going to take it. So y'all got to understand that investing literally means the long game, at least 5 to 10 years. There's nothing that you should actually invest into that you're only going to hold for less than that amount of time. Now, I'm not talking about trading. I'm not talking about anything like that. I'm just purely talking about buying and holding shares. If you're doing it, you need to think about the future in mind. It needs to be a long time horizon. That is where your money will actually grow. See, a patient investor understands that it takes a long time for these things to compound. If you have a long-term portfolio, just stop checking it every single day unless you have the emotional power to be able to sit on your hands and not move. If you want to see those heavy returns, stop touching it. You really got to let it play out. You can't just interrupt the interest. If you keep doing that, then of course you're not going to see some of the returns that you see myself or somebody else post. I guarantee you, the long-term investors, the people that actually win, are the people that buy these things and then they walk away. Let it do its thing. Now, if some major news comes out, like I just talked about, then there may be an opportunity to get out. But absent that, just because it went down in a day, if it's a good stock or a good company, why not buy more? That's the whole game. So sometimes if there's just bad news coming out, that's just an opportunity or a discount for you to be able to purchase more shares. That's exactly how you invest. And then the third reason you keep interrupting with your interest is because you're commingling the lifestyle money with the stock money. Now I know some of y'all be using y'all stock account like it's a checking account. Deposit in, withdraw out. Deposit in, withdraw out. That's not how a brokerage account works. Really, to be honest with y'all, money should actually just go into your brokerage account, purchase shares, and then play for the long game. But this in and out, and then you having daily life expenses out of your brokerage account, would you expect to see some money? I know I wouldn't. So just understand, the brokerage account is money that you don't touch. That's money for the future. That's money for your legacy. See, compounding only works when you don't touch it. All right, number 3, the reason why you're investing and you still broke is because you have unrealistic expectations. Now, you're buying these stocks that Susie Carmichael told you to buy, thinking that they all at. Thinking that, hey, if I put in $20 today, tomorrow I should at least have 15 million. No, I'm actually not over-exaggerating. Some of y'all think if y'all put in a couple of dollars that you're supposed to be seeing millions tomorrow. And I'm here to tell y'all, that ain't how it works. Investing is a long game. If you really want to see some gains, just chill. Just because you see somebody else post a screenshot of what they made doesn't mean that you'll see those same returns. You don't know when they bought, why they bought, or you don't even know the financial instrument that they use to get those returns. So stop comparing yourself to somebody else. Y'all all know the quote, comparison is the thief of joy. Don't compare yourself to nobody else. The only person that you need to compare yourself to is yourself. Focus on your better self and stop having unrealistic expectations of a stock. A good way to understand how a stock will grow is if you go to Yahoo Finance and type in the ticker and then check out the 1-year return and then the 5-year return. So what that'll actually show you is what the stock has actually done. The past is not going to tell us exactly how the future is going to turn out, but it could kind of give us a guideline or a ballpark figure of where we believe the price is going to go. So if you see that the stock has returned about 30% every year for the last 5 years, then you kind of know where to gauge your expectations. Don't believe that this stock is going to jump up by 5,000% because it's never done it before. So just tailor your expectations on what you think the market is going to produce. Another reason why you have unrealistic expectations is because investing is boring. It's boring as hell. You probably want to click on the buttons. Maybe you even want to look at some charts. But you got to understand, like I keep saying, y'all, investing is for the long term. You have to be trained money. It's no different from fitness. You don't go to the gym one day and then all of a sudden you got a six pack. That stuff takes time, man. And it takes a lot of work and it takes a lot of dedication, day in and day out. There's no difference with the stock market. You put that money in at an opportune time and then you let it chill. The hard work when it comes to investing is sitting back and just continue to research while your money's doing the work for you. Get it? It's boring, but it's lucrative. So if you can get over that, you're going to be all right. Another reason why you're investing, but you're still broke, is because you're not putting enough money into the system. See, with investing, you get out what you put in. If you're only putting in $5 to $10 per month, why would you expect these crazy returns? See, with investing, what you have to do is you have to put it in enough capital so that that can grow into something monstrous. Now, of course, you want more money that you put in, and I get it. But understand that everything is off of a percentage. My grandma used to always say, baby, you got to pay yourself first. Before you pay those bills, you got to put a little bit to the side for your future because it will carry you. I understand right now money may be a little bit tight, but you have to budget correctly. Cut your expenses and anything that you have that's extra, just pour that into the market. Even in an index fund, that'll grow over time. But you need to leverage the additional income that you have if you want to see these heavy returns. That's the whole point, y'all. Don't expect to get rich in the market if you're not putting in an adequate amount of capital. It just ain't going to happen because the numbers don't support that. You really want to get wealthy in this game, it's going to take some sacrifices. But just understand that there's a bigger play at hand. Another reason why you're investing, but you're still broke, is because you're not budgeting correctly. For instance, you keep eating out. You out smoking hookah, you popping bottles, you buying new shoes, traveling, you eat out every single day, crab legs, crawfish, whatever. But every time that you're doing these things, you're actually taking out money that could be put into the market. See, if you actually eat out less, maybe pop one bottle instead of two. Maybe instead of smoking hookah every day on the weekend, you maybe just pick, I don't know, just Sunday. If you start to trim back some of your expenses, you could leverage that capital and put that in the market. Now, if you put these things in the market and as that grows, then over time, you could circle back and then get back into some of the lifestyle things that you're doing. Understand that you got to pay yourself first. Pay yourself before you pay your bad habits. Damn, that's a bar. Y'all got to pay yourself before you pay your habits. Because if you don't, you're going to stay broke. Yeah, you have an account, but what is it looking like? Have you touched seven figures yet? If you haven't, you shouldn't be eating out every single day. You shouldn't be smoking a hookah. Got to put the crab legs down. Like, I get it, man. Crab legs are fire, whatever. But understand that every time you do that, you're eating away your future. You're smoking away your future. You're traveling away your future. Enjoy your life. I ain't going to tell you how to spend your money. But what I am going to tell you is stock market is really just a simple equation. What you put in is what you get out. That's simple. And finally, the reason why you're investing, but you're still broke, I'm going to slow down on this part, is because you don't play the tax game like the rich. I want to give y'all an example, and then we're going to break this down real quick, okay? I just purchased a new commercial building, cash, from my returns in the stock market. Yep, I took my money out of the stock market, and I went to go purchase a building in cash. Now, for some people saying, hey, real estate's not going crazy like that right now. You should have kept your money in the market. Y'all got to understand that it's a deeper play at hand, right? I want to talk to you about the tax code. They have something called cost depreciation segregation. Basically, what it does is it allows for you to take the depreciation on an investment property to offset gains. That means less taxes, which means that's more money that I get to keep. So let's talk about the building. With the building, I plan to take out an equity loan. On that equity loan, they'll probably give me a competitive rate, right? But they'll give me the appraised value of the particular building. The building I bought, I got at a very, very good deal. And the amount that I spent on it is much, much less than its appraised value. But I could take the appraised value and then leverage that amount from the bank. That's cash that they give me back, okay? I take the cash that they gave me back, I put that into the market. Knowing me, I'm probably going to put it into QQQ. QQQ has returned 20% or more for the past 5 years. And in my belief, with all the AI stuff that's going on, it's going to continue to grow and even exceed 20% per year. But who knows? Either way, I'm going to take that money and then I'm going to pour it into an index fund and just let it chill, leverage it. Now, the loan payments on the building. Well, I have this building, right? That means now I got tenants. And what my tenants are going to do, they're going to pay rent every single month. They're going to be the ones paying off my loan. Every time they make a payment, I'll take that and pay off my loan. That's exactly how you get a building free. See, that's how you got to think when you're actually investing. See, I'm actually proud of y'all because at least you're investing. You've already taken the step to make yourself better. Matter of fact, I just appreciate y'all for just supporting y'all boy. Y'all go ahead, subscribe, y'all like, y'all share, because there's a whole lot of game that I gave on this. But anyway, that's how you see heavy returns. And that's exactly how you got to play this game. See, the whole point of investing is to get rich, but you've been doing it totally wrong. I want y'all to watch this video as many times as you need to so that you can begin training yourself, right? Because if you're going to be investing, you want to get rich. And you need to address the things that I talked about in this video. Now, that last tidbit, the tax part, I think about doing another whole video over it. I just had to tell y'all because I was overwhelmed with excitement. Because today I got a building for free. And you can do it too. You just got to stay in the game long enough. Now, understand, work on your habits, working on your process, right? It ain't about any particular stock. There's thousands of them. But what it is about your habits and it's about your process. Stop being untrained money. You look down on untrained money. We're going to be trained money, y'all. We're going to get better, better, better. That's how you see the heavy returns. I appreciate y'all's time. I'm going to keep dropping these. If you need help with becoming trained money, promise I got something that's in the works for y'all. So excited, but it ain't ready. All I ask is that you subscribe right now and you just stick with me. I'll see y'all next week. Peace.